hear us all bantering. We're going to start in about 2 minutes to allow everyone in the room, especially for those stragglers that their meeting's running late. But we're excited, to bring our spring edition of the 2024 election year and our thoughts on the market and the economy and providing our perspective. The host today will be myself, Cynthia Yang, who heads up our investment team, and our senior advisor, Chelsea Hussey. And we're excited to just, kind of get rid of some of the myths that are out there and kind of get to the facts of how things could really impact you. I know it's a great spring. The Cleveland was real blessed to have the women's Final Four that went over real well with the national media. Saw some great games on TV. The Guardians are off to a good start, and the Cavaliers seem like they're mending, and hopefully we'll hit a good, playoff run so that we can keep Donovan Mitchell here in Cleveland a little bit longer. So, but with that, I'm going to get started, and we're going to talk about a couple key topics today in regards to what we think you would need to know to help make informed decisions. As you saw the disclosures flying by, we are legally bound to tell you that this is educational information only, and any information gathered from this, please talk to your financial advisor, your CPA, or your attorney. So, you got to love FINRA and the SEC for, keeping close tabs on everything. But we're going to jump in, and, the key topics that we're going to focus on are the election and the markets, the economy, labor market, inflation, the Fed rate cut, and portfolio implications and positioning, and trying to take advantage of, the current of where the economy is going. I will be handling the first topic, which is the election. I don't know. I think I got that hot potato on that one. And Chelsea will handle the economy and the labor market, and Cynthia will talk about the inflation, the Fed cut rate, and possible portfolio implications and how to position your portfolio. And at the end, we'll open it up to Q&A. So please, you either can send through the chat function your questions that way, or we'll open up the microphone so that people can ask questions. But I think the chat function is much easier because then we can see all the questions, and we'll all try to participate and provide our thoughts. So with that, we're going to jump into the election and the markets. It's going to be very interesting. I feel like, this is like deja vu. We have two of the same main players coming back, assuming nothing happens at their conventions. But it looks like it will be former President Trump and President Biden going toe-to-toe again. And, unfortunately, the media has contributed, besides the two main characters, the media has contributed to the polarization of what's going on, and I think that creates a lot of uncertainty in people's minds, because they do view the president as like the key player and the Wizard of Oz behind the curtain that makes all these things happen. And I think we're going to go through a couple slides to show you really potentially how less impactful the presidency is, and who is in office, whether it's a Democratic president or a Republican president, and really kind of focus in on what really drives the market. But obviously the election makes for a lot of news, a lot of talking points, and again, a lot of public sentiment either way. So the first slide we're going to focus on in regards to the market is stock market returns between elections. And again, this feels like deja vu, and I think because of the constant coverage from the last election to now, it just feels like it's been 24/7 coverage between former President Trump and President Biden. But the data we're going to talk about here is 1 year post-election, year 2 pre-midterm, year 3 post-midterm, and year 4 pre-election. And the data here really represents a time period from November 30th, 1950 to November 14th, 2023. And it's broken up into 12-month increments for each year of the term, during the president's tenure. And since 1950, you'll see that U.S. stocks have averaged returns of 9.1% in election years. And this is based off of research by Fidelity's Denise Chisholm, who's the director of quantitative market strategy. Now, I'd like to caution everyone that the market, or really to keep in mind, the market has been, historically risen over time. And that's basically 3 out of every 4 years, the stock market is positive. So it's not really surprising to see an upward trend in all the data. But if you look really at the historical dates, and what I want to focus in on is, you'll see, the midline, which is zero return, and you'll see to the green, the maximum return possible during that term in office. And then to the left, the possible minimum, or the floor in regards to the volatility of the markets. And what you'll see in year 4 is that tends to have the widest range in regards to that. And typically, because of the election, there tends to be rumors of what each president's going to put on their platform, and how the presidency will play out. And what happens, what people really need to understand, I think, in regards to this, is that each president does tend to create an agenda. So what you'll see is certain niches might become more volatile than others. So when Hillary Clinton was vying for the presidency, you saw a lot of drama and movement in pharmaceuticals. With President Biden, he made it a key cornerstone of his campaign to support for green energy spending. And then former President Trump and his commitment to fossil fuels as a bridge to green energy. So that's why you tend to see a lot more volatility in year 4. But when you look historically at the numbers, the markets still tended to be positive from an historical standpoint since 1950. And going into this year, we think that this will be the same. We think we'll still have another positive year. In retrospect to last year, which we had great returns, but people need to keep in mind, 2023 was partly a makeup year for the bad 2022 year, and then positive returns based off of solid economic data. The second slide really kind of dives into the whole premise of the various niches. And what you'll see on the left-hand side is we put some of the major S&P 500 companies in the sectors that they represent: energy, communication services, financial, and the rest there. Now, real estate's not included because there wasn't a lot of historical performance sufficient to put that information on this chart. It didn't really become an independent sector and monitored really closely until 2016. So that was really left off this chart. And what you'll see here, again, looking at the divided line down the middle, to the left, you'll have underperforming years, and the blue boxes will be a Democratic president, and the red boxes are a Republican president. And to the right, you'll see outperforming years where, again, blue is a Democratic president and red is a Republican president. So while it's possible to and there's always conjecture. I mean, that's what you go on TV all the time, and everyone's posturing as to what they are going to foresee. So while it's possible to anticipate potential policy impacts at a very high level, the reality is, based on the data at this stage, there's no one we've found, or no resource that we've been ever able to locate to tell us and help us predict with certainty which party will win and what institutions will do well, let alone the sectors and industries and the specific stocks that may benefit by the next administration's policy. So this unpredictability, again, is backed by the historical data on the sector performance. And what you can see is there is really no pattern at all. What I like to point out, though, is that, again, there's a dramatic difference between what any candidate proposes and expresses on their campaign trail and what actually changes when that candidate in office is able to accomplish. It's exceedingly rare that a candidate will be able to deliver exactly on what they propose once they take office. And a lot of that has to go back to, the function of our government. There's a check and balance. We have a House of Representatives, there's a Senate, and then there's the presidency. And unfortunately, the presidency being the key player tends to get all the press. And what we really try to teach everyone is you really need to focus on the House of Representatives and the Senate. I think people take for granted that, oh, we have just a bunch of representatives and really the president's driving everything. If you actually look at our Senate, there are actually 16 current standing committees and 67 subcommittees. All right, so that's where a lot of the action happens. Same thing in the House of Representatives. There are 20 standing committees and 104 subcommittees. So if you want to know where legislation is starting and what potential legislation might be written, I think you need to look at, especially if you're looking at party lines, what party is in charge of, what committee. So for example, on the Senate, some of the main committees are agriculture, appropriations, armed services, banking, housing and urban affairs. This is where all the action happens. So I think what gets lost in all the media is really where the legislation starts. And because of the fact that we've had a pretty balanced government in, between the House and Senate most of the time, you get much more compromise. So in other words, that middle of the road. And I think that's why, regardless of what president gets in the office, it's rare that the president can get their entire agenda through Congress the way they promise, when they're sitting up there running for office. Next slide, and I think this really bears a lot of fruit to this. So markets are very nonpartisan. And what you'll see here on the left-hand side is a graph that talks about having a Democratic president, a Democratic House, Democratic Congress, a divided Congress, and a Republican Congress. And on the right-hand side, you'll see a Republican president who has to deal with either a Democratic Congress, a divided Congress, or a Republican Congress. And this data runs from 1933 to 2022. And although we want to have popular myths that suggest that one party is better than the other for market returns, the historical data does not bear it out at all. Markets are very nonpartisan, so it's very important not to base your investment strategy on the outcome of an election. What the markets really look for, and going back to that first slide, and when you look at the changes there, what the market really looks for is clarity. When you see the market becoming very, very volatile, it's when there's a lot of speculation, a lot of uncertainty on where, what decisions will be made. In other words, the rules that the market has to play on. Again, looking at this, the S&P 500 has historically averaged a positive return under nearly every partisan combination, as the chart above shows. And in fact, there's clear evidence that the divided government has historically correlated with a stronger market returns because there tends to be, lack of a better word, more gridlock. I like to look at it as more compromise. And so you'll see when you look at a Democratic president with a divided Congress, the market, the S&P 500 is at 13.6%. And when you have a Republican president and a divided Congress, you're at 13.7%. So what this really bears out is once the decision's made and we know who's in office, it's really the market that's going to, the market's really going to be more determined and driven by economic fundamentals such as corporate earnings, interest rates, and other economic factors. I mean, the big one this year, which will be talked about later, is what will the Fed do with interest rates? I mean, we're going to be anticipating going into soft landing. When are they going to cut? So that's going to be a bigger theme. It has really nothing to do with whether we have a Democratic president in the office or a Republican president. So I hope these slides really have clarified that while there's a lot of talk and a lot of excitement, whether you're at the bar or at home over the kitchen table or you're talking with friends, and I know it's a dangerous game when you talk politics, the data clearly shows that while there is volatility up in an election year, regardless of the president, the markets tend to be positive, especially if you have a divided Congress, and it's really hard to pick a market niche and say, oh, this market's going to do better than another market. I think really the fail safe is always look at, when you look at a company, you're looking at a couple things. You're really looking at, is the company going to drive cash flow? Is the company going to continue to grow? Does it own a special niche in the market because they have certain technology or patents? I mean, you look at the Magnificent Seven, for example, NVIDIA, for example, Netflix, they tend to corner their market because they have size and scale. Amazon's another. And so because of that strength and their positioning in the marketplace, they're able to perform better than their peers. So again, you have to really look at the company, its position in the market. Does it have certain competitive advantages over its competitors? What do the economic factors bear on that? And I think that's really going to lend itself to saying, will this particular company do well this year and on an ongoing basis? Okay. So if there's any questions, again, please save them for the end or put them in the chat. But we'd be more glad to answer any more questions about the election or the presidency and its impact on the markets. With that, I'm going to turn it over to Chelsea and have her talk about the economy.
All right. Good morning, everyone. Thanks, Frank. Beginning with our discussion of the economy, first, we're going to take a look here at the left-hand side at real GDP. So real GDP, this is not nominal, so this is adjusted for inflation. And this shows the 20-year trend. You can see it's averaged around 2%. After the pandemic, the U.S. economy recovered rapidly in 2021. You can see that big acceleration there. But following that, the growth began to moderate in 2022. Going forward, there is an increased chance of recession, meaning negative GDP growth, as higher rates continue to weigh on the economy. But looking at what the overall breakdown has been for 2023 of the components of GDP, you can see that consumption was by far the leader, the key driver in the GDP results for 2023. The overall theme for this slide to keep in mind is, one, those two negative quarters that we saw in 2022, while those would technically constitute a recession per textbook definition, they were really more of a moderating of that accelerated growth. And then two is, again, understanding the component of the GDP. The consumer continues to be a big key part of our economic strength. So let's dig a little deeper into what those components of GDP are. You can see that over time, this chart breaks down into areas like government spending, net exports, again, consumption, trade. Consumption has been a pretty consistent positive driver, and it was especially in 2023. Other components have been a bit less consistent. For instance, inventories and trade, they've been especially volatile since the pandemic. For GDP accounting, something that is a little bit interesting to keep in mind, inventory accumulation, businesses having more and more inventory on hand, that boosts GDP, while falling inventories, those drag GDP. So even if consumers are buying a lot of things, if businesses have enough product on their shelves to meet that demand, it's not going to boost the GDP. It's not going to move the needle there. Now, we've had some supply chain dislocations and even high inflation. That's really contributed to the volatility in the business investment space. And trade has been sensitive to bouts of not only a stronger dollar, but economic momentum abroad. So let's take a look at long-term drivers of economic growth. This is interesting. This breaks out GDP and then those different factors contributing to that real GDP on a decade-by-decade basis. So you can see the orange here. This highlights what that real GDP is. The blue represents growth in workers, and then that gray chunk of the chart represents growth in output per worker. Now, the aging U.S. population, this poses a headwind to overall economic growth going forward, but it could be offset by greater output with technological advancements. So things like increased automation, artificial intelligence, these might help offset those labor shortages and drive significant productivity gains. If you take a look at the 1960s, for example, that period of rapid industrialization, or even the 90s, you can see that that increased productivity with the 90s and the introduction of the computer. Both of those decades saw a huge increase in overall productivity, which greatly contributed to that GDP growth. Conversely, in the 70s, you can see that really the big driver of the GDP growth there was the population growth. This was both in part due to immigration, but also an entire generation of baby boomers coming of working age. So let's take a look at how the US consumer is doing. Consumer balance sheets, taking a look at the left-hand side first. These held up remarkably well through the pandemic, thanks in part to massive fiscal support. On the top right, we want to contrast that balance sheet with the US household debt service ratio. So this is the portion of a personal or disposable income going toward debt payments. You can see that during the pandemic, this reached a historic low, and it's been gradually creeping back upwards. Similarly, the chart below that, 30-day delinquencies in credit card, auto, and student loan payments. Again, a bit of a drop-off, especially with student loans, of course, but during the pandemic, and we're beginning to see those numbers rise. The overall theme I'd like you to gather from this slide is, one, the consumer balance sheet, while it's certainly tightened, isn't necessarily in a bad space. Because we do have a headline-heavy year ahead with the election and so much focused on the economy, you're likely to see a few more doomsday-type reports where they're saying delinquencies are on the rise, or more and more households have a larger share of their income going toward debt service. And if they're really just looking at, let's say, from 2020 onwards, certainly those numbers would be trending up. But what's nice about these charts is they help you to pull back and get a little bit more of a historical perspective and see that, yes, while these numbers are rising, they're certainly not in any sort of like bubble type 2008, 2009 territory. They're more returning to their longer term averages. Digging a little deeper into how the consumer is doing. On the left-hand side, we're looking at the personal savings rate. This is based on their share of disposable income. You can see the first year of the pandemic, huge spike between business activity slowing down, as well as the financial stimulus a lot of people received. Their savings rates skyrocketed. However, coming out of that, not only did we have people re-engaging in the economy again, but we also had rising prices due to inflation. And so that really brought down that savings rate to below averages, likely because of what we saw again with again this big influx of savings that did have to be spent as soon as that pent-up demand was sort of released back into the economy. Now, if we look at household excess savings, this is a little bit more again, it kind of reflects this this sort of increase again that we saw with saving during that pandemic, the pent-up demand sort of releasing that, and then again the revolving consumer credit below that, seeing that tend to rise up. A lot of these last two graphs can really be attributed, I think, to higher rates, the higher cost of borrowing. It is starting to, I think, between that and overall inflation and prices of goods creeping up, a lot of that is contributed to the contraction of some of those savings rates. So as we talked about on the previous slide, household balance sheets are still relatively strong, but we're moving a little bit more towards those averages or those historic averages of what we've seen. So digging into the labor market, let's take a look at this chart representing unemployment and wage growth. So these are 50-year averages. You can see the 50-year average for the unemployment rate has been 6.2%. And then for wage growth, it was 4%. These are civilian unemployment numbers or non-supervisory positions, and this is going back to the 1960s. The two of these have had an inverse relationship with one another. You can see we had a red hot spike in this blue line here, wage growth in 2022. The average having been 4%, we saw a spike up to 7% in 2022. With that, though, the labor market is showing some signs of slowing. Wage growth is starting to cool down a little bit. The economy is beginning to slow down somewhat, and those declining corporate profits are easing some of that upward pressure on the wage growth. And then in addition, with the unemployment factor, there is still a large backlog of job vacancies, which we think should help absorb, again, some of those positions that people are seeking, which will help keep that unemployment rate a little bit lower for longer. This next section here, we're looking at labor demand. This is the JOLTS report. This stands for Job Openings and Labor Turnover Survey. We can see we had a peak, a record 12 million job openings in March of 2022. We're falling back toward normal levels, but we're still above those historical trends. Again, we think this will help to keep unemployment relatively low. There's still a buffer of some excess labor demand. Looking also at the JOLTS reports for both quits and layoffs, we saw some spikes in both of those, but they're beginning to moderate slightly again as well and move a little bit back toward those historical levels, which really is a welcome signal, I think, that because we're moderating from those highs, that elevated labor market churn has finally subsided. And then finally, again on the layoffs piece, it sort of seems like if you follow headlines, you'll see, you know, Facebook or Meta is laying off, Spotify, some of these larger tech companies, and especially last fall, it felt like there was a new headline from those every week, but we're still quite around those historic lows, and really I think this is in big part to a lot of these businesses wanting to maintain their existing workers to help offset some of these structural supply shortages. All right, the last piece we're going to look at here is labor demand. Labor market dashboard. This is just a quick health check, if you would, on how the labor market is doing. On the top left, we have non-farm payroll gains. Non-farm jobs account for about 80% of GDP. And so this is a really good way to get a feel for how many jobs are being added to the economy and where we're seeing some of those gains. The 3-month average looks like right around, it's tiny for me, but about like 280 something thousand. In January, it was a little bit higher. The most recent data for March was 303,000. So again, we're keeping a little bit above our 3-month rolling average. Where I think this leads us to an interesting demographic discussion is this labor force participation. If you take a look at these, so moving over to the right, these two blue lines here, the dark blue represents the worker demographic of those above 55, and the light blue is below 55. And you could see that prior to the pandemic, their workforce participation rates were essentially in lockstep. And then we had the pandemic, which really was a catalyst for, I think, a lot of people in the 55 plus range considering an early retirement. I know we had a number of clients that made that decision a few years ago. We also saw a bit of a drop off then for the under 55s, but we're beginning to see their participation climb back up to their pre-pandemic levels. And as I mentioned on those previous slides, while we do have a portion of our workforce that is aging out, if we have increased productivity per worker, that should help support the economy throughout that. The last chart below here is this labor market dashboard is a heat map of these different labor market indicators. You can see with red meaning negative going down, green, good, growing. Going to the very end of this chart here, the far right side, you can see that everything is trending relatively in a positive direction, with the exception of small business hiring plans. There's I read recently that in a recent survey of small business owners, it's called the Small Business Owner Optimism Index. It's at the lowest rate since or score since 2012. And I think this is a part of a few different factors. One, we still have a lot of high input costs. Inflation has tamed somewhat, but it's still putting a lot of pressure. There's still some difficulty for a lot of small business owners in finding skilled workers. And then higher interest rates overall make the cost of capital just that much more expensive. Looking at this year, I think there was a lot more optimism at the beginning of the year that there would be more like 6 or 7 rate cuts, and now it might be looking more like 2 or 3. So a lot of that has really contributed, I think, to the overall pessimistic or guarded attitude of small business owners. But I would encourage the participants on this, or anyone who's listening, if you're a little bit more of an economics nerd, or you just want some very dry reading to help you fall asleep, is to check out the Federal Reserve Beige Book, which is released, I think, bi-monthly, I think every other month. And what this has is for each Federal Reserve branch, so St. Louis, Richmond, Boston, Cleveland, it gives you an overview of the overall economic conditions. Now, for many of you, especially if you're a business owner in Ohio, you probably have your finger on the pulse of a lot of our local economy, but it's not only interesting to get a perspective from different segments within our economy, but also see how those other areas are doing in different parts of the country. So to get I think, a better idea of some of those sentiments, I highly recommend checking that out. The overall takeaway, I would say, from these two sections is the overall fundamentals of both the labor market and the economy show a slowdown and a cooling off, which is really what the Fed is trying to navigate. But it's not necessarily moving into a scary or anxious territory. It's more of, again, what the Fed is trying to do with that soft landing. But to really continue our discussion more in depth with the Fed, I'll turn it over to Cynthia next, who will talk about the Federal Reserve as well as inflation.
Well, thank you very much, Chelsea, and good morning, everyone. On the next section, before we really dive into the US, let's take an overview of the global inflation on this heat map. It's a busy chart, but bear with me for a second. On this heat map, really, the red are indicating inflation is accelerating or heating up, and the blue indicating the inflation is decelerating or cooling down. As you can see on this chart, most of the countries and territory in 2022 are experiencing some sort of inflation, and the central bank kicked in and started to battle with inflation with the monetary policy. And in 2023, we started to see that the inflation moderating globally in general. At the end of 2023, the global inflation was around 3.3% comparing to the year end before in 2022, where inflation was around 8.27%, which suggesting in the last calendar year, the central government globally have done a great job controlling inflation. Japan, France, and Taiwan are the 3 countries on the map here, are still in deep red zone in December 2023, but as they enter into January, all 3 countries show inflation decelerating. As long as that path continue, it will be less of concern for those countries. One of the outliers I would like to point out on this page is China. China is the only country that are right now experiencing a deflationary market, and it doesn't really seem that the trend has reversed yet. Mild deflation isn't really a big concern, but deep deflationary market will hurt employment and consumer spending. and could potentially create a snowball effect down the road that hurt the economy. We will spend a little bit more time later to discuss about China's economy and what does it mean and what you should do as an investor to position your portfolio accordingly. On the next page, we will zoom into the US. The table on the top provides the Fed expectation about the GDP growth, the employment, and the inflation in the next few years. And this table indicates Fed is really expecting economic growth to slow down, but remain in the positive territory. That's what we and the media has been referencing to in the last couple of quarters, soft landing, not a recession. The line chart on the bottom provides the Fed and the market expectation of the rate policy down the road, starting from 2023, end of 2023, and where we're going to head from there. One thing to point out before we focus on the chart is this chart is updated at the end of February. It was way less concerning than the chart that we had at the beginning of the year, which Chelsea pointed out that at the beginning of the year, market were expecting 6 to 7 cuts, where Fed said that, oh, we're considering 2 or 3. That disconnection between the Fed and the market was very concerning at the beginning of the year. But now with the updated data, we can see on this chart, the Fed and the market are pretty much in line with their 2024 rate cut. Fed are indicating there might be 3 cuts by the end of 2023 and take our rate down from about 5.4% to 4.6%. Market does expect a little bit more than that, but it's not way too off, which tells us that this is really a great tailwind to the market that Fed and the market are in line. That's suggesting that down the road, market volatility will be less impacted or driven by the monetary policy. The second point that worth noting on this chart is the rate expectation beyond 2024. Fed expect to eventually cut rate and take us down to the 2.5%, while the market expect that the rate will stay higher around 3.6% beyond 2024. If the reality match what Fed gonna take us to, it suggests that in the future, the monetary policy are very likely to provide more positive surprises than negatives, and which will potentially boost positive market returns. And this chart is really take a look at both the nominal and real interest rate from 1958 through today. The interest rate that had been falling for the past 30 years until very recently, leaving both nominal and real yield historically low. Now, the real yield has been hover around 0 or below 0 for at least a decade, until very recently we started to see positive real yield. As inflation continues to slow, we do expect the real yield will stay and move higher into the positive territory, which will be a great tailwind for the investors in general. Now, with all those discussions we have talked about today, the inflation, the economy, the employment, and the monetary policy, what does this really mean for you as an investor, and how should you consider position your portfolio going forward? Before we really focus on these slides, I would like to share 2 positive signals that we observed in the market in the last few months. First is market started to focus on more on the fundamentals than the monetary policy. If you follow the market very closely in the last few months, you probably have noticed that how resilient the market has been after there is inflation news, after Fed make any update about their monetary policy. Market did react to those news, but only for a few days, a day or two, and quickly rebound back to normal. That really tells us that inflation and monetary policy is no longer the center of the attention. Instead, market is much more focused on the earnings, the company profitability, and the fundamental economy growth. And secondly, market rally broadened outside of the Magnificent Seven and the technology sectors. We all enjoyed a great rally in 2023, but most of the growth in that year was driven by the Magnificent Seven and the technology sector. If we take S&P 500 as an example, in 2023, S&P 500 rallied about 24%. 20% of that return was really driven by 7 stocks, and the rest of the 493 stocks only contribute to 4% of the total return. Now, this year, even though technology are still leading the growth and the rally, other sectors catching up. We see that communication services, energy outperform technology as of year to date, with financials and industrials not really so far behind technology. So as a diversified investor, we could participate more to the recent market rally than what we have experienced in 2023. So now let's focus on the chart on this page, which really provide the historical market returns around the end of the interest rate hiking cycle. The chart on the left shows stock returns 12 months before and 24 months after the last rate hikes. We are already 8 months into the end of the rate hiking cycles. So far, the red line is the most recent cycle. It is pretty much follows the historical average trend. The only outlier out there was 1999 to 2000, which when we experienced the tech bubble. So if the trend continued to follow the historical average, it tells us that going forward, we can expect more potential growth down the road from the equity market. And on the right, it's the same chart. We're looking at the bond market with the 10-year US Treasury yield. So far, it doesn't seem that the bond market is following the trend yet. One of the reasons for that is Fed and the market just keep pushing the first rate cut down to the road. At the beginning of the year, we were talking about maybe we're going to have the first rate cut in March. Now it got pushed in June. If the economy continue to grow, the employment market continue to hold on really well, that first rate cut may be pushed down to the road into early fall or later. It could happen. So, but if this historical trend continue to hold, that just suggesting that down the road, fixed income market could potentially offer more. We haven't really started to see that rally yet. We need to give it a little bit more patience to the fixed income market. Now, this is really dive deeper into the different asset class sectors into the stock market. In general, we are in favor of large and mid cap, but not so much about small cap. Chelsea have already discussed about the pessimistic about the small cap business owners, and we're going to dive a little bit more into that. The chart on the left is not a really bigger concern here. It really looks at the sector breakdown for small caps comparing to the large caps. as you can see here, large caps have more exposure to technology, to consumer staples, where the small caps tend to have more exposure to healthcare, financials, and industrials. This suggests that from the sector standpoint, small cap tend to be more cyclical or volatile than large cap. We are still at the end of the market cycle. We're not ready to be hero yet to take on more risk until we are ready to start a new business cycle. So at this point, we like to enter with small cap, and more the reason to the two chart on the right. The chart on the top shares really look at the shares of unprofitable companies in the Russell 2000. Russell 2000 is a blended small cap index. So as we, in the last few years on this chart, it indicated that there are more small cap companies becomes unprofitable in the index. Small caps tend, well, small cap companies tend to be having a little bit lower quality, making their earnings much more sensitive to the economic cycles. But if you still like small cap, what we're suggesting here on the chart at the top is be selective. Find an active manager that you like to work with instead of investing in a low-cost exchange fund, which can give you much more exposure to the companies that are not even make profit. And the chart at the bottom right, we look at the debt maturity schedule of the large and small caps. Overall, large caps tend to have less leverage comparing to small caps. And beyond that, when you look at the loans that they carry on their balance sheets, large cap tend to have more fixed rate debt. They lock their rate for much longer, which means in the current interest rising environment, it doesn't impact the large cap as much as the small cap. Small caps in generally, they are doing better when we are coming out of the recession. At this point, we want to be a little bit mindful of where we are in the overall market cycle and enter with small cap until there are better indicators telling us that we are at the beginning of the next new business cycle. And lastly, I would like to spend a little bit more time on China. We already talked about China has been experiencing this deflationary market, but there are more concerns than that. The chart on the left shows that China has experienced many years of fast and stable growth, but it has been slowing down in the past few years. Well, even though that the government has been trying to work their way out to help reboost the economy, it just doesn't seem that it is started working now. And what really concerns us the most are the two charts on the right. The bottom chart on the right shows that the consumer income confidence are at historical low. The consumer are just not confident that they will bring home more income than they had in the past. And the top chart in the on the right shows that the household deposit are around the all-time high. This is really worth concerning because it just shows that the consumer and the household, they're insecure about their financial future. They expect to make less and they want to save more. And that means there are less spending in their economy. It's not a really positive sign to the economic growth for China down the road. So with that, we're trying to avoid China until there are better signals for now. And that really conclude our presentation today. And just as a quick recap, the several key discussion points that we've talked about today is market really don't take size. Down the road, on the long run, market really focus on economic fundamentals. Short-term election may swing the market returns a little bit, but on the long run, you will be better rewarded, make your investment decisions based on the fundamentals, not the election outcome. And the long-term economic growth is expected to moderate, but we do expect that artificial intelligence and automation might be a great catalyst to help boost the productivity, which in turn gonna help boost the long-term economic growth. Labor market started to softening, but as Chelsea pointed out, we do not see there's a bubble down the road yet. And a positive sign to that is as labor market started to softening, it will help to take off some of the pressures on the inflation. And lastly, we like large cap, mid cap in terms of asset class. We try to underweight small caps, and we try to avoid China. Bond market continue as one of our favorite market, but we might need to give a little bit more patience to the bond market. With that, I will open the floor for any Q&As.
Don't be bashful.
Do we have any questions in the chat box?
No, I was checking the chat box.
Okay. Well, that means that we have done a great job, right?
Yeah. You can always email us afterward too if something pops in your minds.
Yeah, we'll hold on a little bit here, just make sure, if there's thoughts on what's going on. See any?
No.
No, well, I want to touch on one thing. We touched on a little bit, and it really has to do with the Fed. I think a lot of people, you saw some volatility earlier in the quarter because there was word that the Fed was going to lower interest rates. Right now, it's predicted that the Fed's going to lower interest rates by 75 basis points by year end. And they thought they were going to start in the first quarter. And when it didn't happen, the market had a week or two of consternation. And so, it makes us reflect. I was reading an article that was put out, and, a couple things that we need to look at is, is the Fed too tight or not? I mean, that's this whole issue with the Fed raising interest rates was a slow down inflation, a slow down the economy. But are we really in a very tight situation based on, the numbers, right? So, there's really it's kind of like a two-part test to determine if a monetary policy is too tight. First, has the economy weakened to a below trend growth? In other words, is GDP falling or unemployment rising? And the second, has inflation persistently declined? So the real question is, if those things haven't happened, is it, can you really argue that the current monetary policy has been too tight? So I think there's some concern that, will the Fed continue to turn and lower interest rates, this summer? If you really look at the real GDP growth, it's about 2% annually through the first quarter, which is close to the long-term average. And it follows, all of 2023, the last 2 quarters of 2022, where quarterly real economic growth was faster than 2%. And at the same time, unemployment remains below 4%. So in other words, in that area, have we had an economic slump that's consistent with, tight monetary policy? So that's a question that we're still kind of discussing, because it's this on the fence. If we tighten too much, do we throw ourselves into recession? If we aren't tight enough and we, open the floodgates, are we going to click inflation? So that brings me to inflation. After, the impact of supply chain and also the flooding of the monetary policy. So when you throw a lot of money into the economy, you can create inflation because you have more dollars available to chase more goods. So we spiked at about 9% in 2022, and then the CPI inflation fell mid-2023 to 3.1%. But if you look from that point on, CPI inflation has the decrease is the decline has stopped. So if we estimate consumer prices rose 0.3% in March, and the Cleveland Fed CPI projects a 0.3 increase for April, CPI will actually be up 3.3% in April versus the year over year. So now you both have real growth and inflation showing little impact from Fed tightening, despite many of the traditional measures of monetary policy signaling tightness. So I think that's what's kind of going to influence what the Fed may want to do this summer. We still think the Fed will take the chance, even though inflation hasn't gone down to their target of 2%. So our Fed has a dual mandate. Unemployment below 4%, inflation at 2%. And are we really in that, heading in that direction? So I think, when you look at some of the things that Cynthia and Chelsea talked about, the economy is still moving along pretty well. I mean, this year we hit higher valuation numbers, and the S&P and the Dow have all peaked. So really, is the Fed tightening too much? And I think that's the question the Fed is really wrestling with in making this decision. I think they want to lower interest rates, but I think inflation, more than really unemployment, is going to dictate. If we continue to flatline at 3.1%, or continue to see more spikes in April and May, there could be enough momentum to tell the Fed, hey, maybe we need to pause a little bit and leave it where it's at, because are the conditions where the economy is really slowed down by the Fed being too tight. So I think that's the big question that we have right now, and we're closely monitoring it, but none of us have a crystal ball. So I just wanted to put that out there because I wanted to make sure we dove into the Fed, because I think that's the bigger player this year than the election. We have one question. All right, I'm going to dive into that. Let's see. Maybe I missed this earlier, but why is everyone so concerned with what their money may or may not do, or because it's an election year? Any of you ladies want to take that, or do you want me to take it?
I can give maybe just a little bit of background.
Sure, go ahead, Chelsea.
It really depends on the person, I think. There are some people who really tend to be a little bit more just patient and perspective focused with the market, and so they're thinking, we'll see how my money does. I'm married to my investment strategy. That's what I'm focused on, and the metrics for making sure that that's performing and that aligns with my financial plan. But then there's other people who always want to find that little element of predictability. They're the people who say, I'm going to get out of the market when it's low, and I'm going to get back in when it goes up again. And they always miss that upswing back, but they're looking for those bits of predictability. And that tends to happen a lot with an election year, where people will say, boy, if I can figure out, I'm going to keep my money on the sidelines until the outcome of the election. Or if the outcome of the election is this, I'm going to, invest here. Or if the outcome of the election is Y, I'm going to invest there. Because again, a lot of people want to find that sense of predictability in the market. So in general, is everyone concerned with it? I think there are some people who are, which is why we want to make sure we address it. What we always try to work with our clients on is understanding that, again, you really can't time the market. It's really best to focus on your strategy and make sure it aligns with your financial plan and your risk profile. But anything you want to add to that, Frank?
Yeah, I think it goes back to everyone has a different relationship with money. How you were raised, how your family looked at money, from a standpoint of a risk, adversity standpoint. My family immigrated here in the late 50s, so my parents were very naturally risk averse, not even with investing, but they didn't even trust banks. So they had money in many different banking institutions because they didn't trust the bank, given what they learned, when they were, growing up in Italy. So your relationship with money, your understanding of money, our firm, most of our clients really were investing long term. So the term being long in the market. So we are trying to, through our investment advice, trying to moderate the volatility. So we take out as much of the lows as possible, given the amount of risk you're willing to take. Obviously, the more risk you're willing to take, your floor or the bottom will be a little bit larger. And as Chelsea pointed out, you really have to tie your investment strategy to your financial plan. They have to work together. They're not independent. And if you're not aligning those together, you could be doing well in your own mind with your investments, but you might not be achieving the financial goals you want. So the idea that Chelsea talked about, timing the market, when to get out, when to get in, that's a 2-decision process. And we don't believe people successfully can operate that type of mindset, over a long period of time. And clearly the people that have come to us, and we look back at some of their decisions, the biggest, and especially in the 401k area as well, the people that have had the worst outcomes are people that tend to try to time the market, get in and out of the market, or are constantly changing their approach to their investment policy. And what that has done is created pockets of poor performance. And then when you look at their aggregate over time, their total return has been very, very poor. But the psychology of money is a whole other topic, but it is really important. And so it's really critical as advisors, when we sit down with clients, is to really understand their relationship with money, their comfort level, the use of that money, because there are people that will, especially now with technology, there are people checking their accounts on a daily basis. There are people that look at their statement every month, and it's like, is that really going to change? Yes, the values will change, right? But is it really going to change the outcome? If you have a strategy that you believe in, that you're making decisions that align with that strategy and your financial plan, you're better off executing that and ignoring what we call the market noise. As you notice, we named, this whole series in our newsletter, Market Noise, because that's what you hear a lot. There's a lot of market noise, but when you actually start to look at things with context, that Cynthia presented and I presented, and Chelsea, when you look at things in a bigger picture with context, you find that things aren't maybe as bad as they should be, or maybe not as good as they should be. Mark Twain always had, I think, that saying, history, tends to look familiar because, it repeats itself, but the characters are different. The things that we deal with today and the tools that the government are using have worked in the past, and they're trying them again. But remember, the players are different. The last time we had super high inflation back in the late 70s and in the 80s, there was no such thing as an internet. There wasn't, amount of global commerce has changed. In fact, what's trending right now is it's deglobalization. What has happened, given all the things that have happened in China and Russia, and all the disruption we experienced during COVID, our companies are moving manufacturing back. They saw that a country losing all its manufacturing prowess became very weak and susceptible to changes through globalization. Now, I'm not saying that it's a right move to be, move everything all back to shores, but I mean, you're starting to see deglobalization as a way of controlling costs, controlling manufacturing. And if you think back, I was at the Cavs game last night, and they honored a World War II veteran who was celebrating his 100th birthday. And you think about all the things that happened with World War II, the number one reason why I think we were able to win and be so successful was our country was so strong in its manufacturing that we were able to respond rather quickly with changing everything. And the whole workforce changed. It was the first time really women in large numbers entered the workforce because men were fighting. So they needed bodies to come into the factories and start to work. So all those dynamics still exist today, but there are different players. India has become a larger player in the consumption market, and China obviously has developed their middle class. So you have to take some of these old these old tactics that still work and understand how they might work with a different stage and different players. But I hope that helps answer the question about, you know, the values. I think people want to look at their values on their own accord, and they look at it as a comfort level. Hey, am I where I want to be? But I think having a short-term view and not a long-term view towards your approach to investing could be short-sighted, and it could potentially undermine, you know, good decisions. We have another question. I'm going to let Cynthia handle this one. We all hope the recession will have a soft landing. Based on the historical data, do you think the recession will come in the next 1 to 2 years of the soft landing? Cynthia, I'll give you a chance to answer that one.
Well, we're not saying there is not a possibility of a recession. It could. There are many things that could go wrong from here in the next 24 months. Employment market continue to be strong, resilient. If that market change very quickly, yes, it could lead us to a recession. There are other geopolitical risks somewhere in the world can pull us into it, could potentially lead us into a recession. Right now, based on the current data that we're looking at, it just doesn't seem that the recession is somewhere near the term. Down the road, there is definitely a possibility. So with that, we don't really think a recession will be here in the next 12 months. The longer down the road, the higher the possibility. And again, we are in the late market cycle, so it will be a recession down the road somewhere in the future. We're just hoping that when that happens, it will be a mild one, that not going to be like the financial crisis in 2008, 2009, or the tech bubble that in 2000 that we experienced.
I don't know if it was you, Cynthia, or Chelsea that showed I think it was Chelsea that showed the graph where GDP was down 2 quarters in a row. I mean, that's technically a technical definition of a recession that we should have experienced, but we really didn't feel like it was a recession. We just kind of plowed through it. So yes, recessions can be deep or they can be very, very mild. I think what the government is trying to do with this soft landing is set the tone for the next bull run. You know, last major bull run came after the Great Recession. And then with all the economic easing, quantitative easing, we had almost a 15-year run 12-year run of a bull market. If it wasn't for COVID, we really didn't know how long more that was going to go. So I do think they're trying to set the stage. But as Cynthia pointed out, there's always that chance that if enough factors and variables happen at the same time, call it a black swan event, just for drama, it could create a point in time where we're in a recession. But as the economic data indicates and the factors right now, it looks like we're going to have this soft landing. And like I said, that I think the big question is, will the Fed be really committed to lowering it this summer if inflation still stays at around 3.3% and is not showing ongoing decline? Because the risk then is if they start to lower interest rate and the money supply grows, so now borrowing will increase, people start spending, will that shoot up inflation? That's what they're working on right now. And again, I'm not the man making the decision. Cynthia's not, and Chelsea aren't the ladies in the room that are making the decision. We're just watching and waiting and trying to anticipate how that could impact things. We do have another question. I'm glad it's opening up here. Does the potential, I'm chuckling at this, but I agree. Does the potential of misinformation that AI poses affect any financial planning decisions? Chelsea, you want to lead that one?
I guess yes and no. I think it depends to the extent that your financial planning team relies on AI. I'm just on a personal note, a bigger proponent of relying on people and their processes than I would ever feel comfortable talking to or consulting with like a robo-advisor regarding financial decisions. So in terms of, I think the overall theme of financial planning decisions, I would say that yes, there is definitely potential for misinformation from AI. But to the extent that we've got that you're working with a live in-person financial planning team that are still using their fundamentals, I would say at least the next over the coming years, I would say that that's certainly a way to mitigate that risk. I don't know if there's anything you want to tack onto that, Frank.
Well, at our firm, I mean, we obtain information from multiple sources. I mean, we do our own research and we're looking at our own data, but then we're also obtaining data from multiple sources. So there's like a check and balance here, and then you start to see, all right, is there a coalescing of thought that this is the way something's going to go, or are you going to be contrarian to that? But it always leads to something I learned. A teacher of mine told me in college. You are what you eat, you are what you read. So the news outlets that you listen to, the papers that you choose to read, the magazines you subscribe, tend to create what I call an immediacy bias. And so what you choose to read is going to influence probably your decision making. So the stuff that we're looking for, yes, everyone's putting out an opinion. But we're trying to look for objective research, objective advice, and then we're trying to create context with that so that we're not making decisions with a narrow mindset, a myopic mindset. But yeah, as Chelsea said, AI is very new. It can be very powerful. I'm sure people will figure out how to use it more correctly. But at the end of the day, our firm is relying on research, again, from a number of sources that have been in the research business for multitudes of years, and our confidence level in the data and the corresponding opinions help shape what we conclude as a team, because we actually work together and as a firm come together with the separate opinions and then agree on how we feel we want to approach investing for our clients as a unified front. So I hope that answers the question. Any other questions? We're a little bit over, but these are good questions, and hopefully the feedback for everyone is very helpful. But if we don't have any other questions, I want to thank, on behalf of Cynthia and Chelsea and myself and the firm, I want to thank everyone, and thank you for all the years of support. We're celebrating our 30th year, so we're very excited about that as our team continues to grow and evolve, and we're trying to find better ways to service and advise our clients. Thank you for listening, and if you like what you hear, please spread the good word and let people know that there'll be other webinars / podcasts coming up, and if they have any questions or things that you come up with after we sign off, please email any one of us. We'll be glad to assist you with. Okay, take care. Have a wonderful spring. Everything's getting green out there. The flowers are starting to come out, and it's looking good. So take care. Stay well, everyone. Bye-bye.